Good evening, everybody. Welcome to your Share CFD clinic. Great to see you all here. And yeah, we've got some stuff to share about Share CFDs. And obviously, before we start, I've just got to make it clear that what we're describing here is in many ways my approach to trading this particular instrument. And of course, any views that I express should be seen as mine only, not representative of markets. We will be having a look at live markets. I'm going to do a little bit of a market watch session because there's some interesting stuff going on at the moment. And then we're going to just talk a little bit about some of the questions that I'm often asked about Share CFDs. I'm going to give you some answers to those. And then I'm going to just talk about exits and a couple of key points about exits that are specific to Share CFDs that I would sort of consider. So just let me know you can hear and see me okay. That would be fantastic. Thanks, Ross. Good stuff. Hi, Rachel. Hi, Ian. Now, one other thing to say is that, thanks, Cameron. The other thing I'll say, anybody who's sort of enrolled for them, you'll all get access to the Share CFD course by tomorrow. Apologies for the slight delay on that. I was just doing a couple of tweaks in the back end to make sure that when you do get it, you get it in completion. So yeah, bear with me on that. It'll all be good tomorrow. Now, the other thing that I've done is I've been a bit proactive on this. I've sort of organized another session for 3 weeks' time. So I figured if we did these maybe every 3 weeks, just to sort of talk about Share CFDs, particularly for those that are trading. Good on you, Richard. Then that might be useful for you. And of course, on top of that, we'll be referencing them in live updates and that we do a couple of times a week and in the circle, etc. Okay, so let's look at across the news now. There was a mixed session on Wall Street last night, and then Nasdaq outperformed. The S&P 500 is still testing record highs. Did intraday, so although it doesn't feel as though the markets are moving much at the moment, we are still towards the top end of forever. So just bear that in mind. US futures are slightly positive. The Nasdaq's outperforming again, which is interesting. Just ignore the question on the statement on Asian markets. Thought I'd change that, but obviously I didn't. Asian markets generally traded mixed. ASX ended up being up. If we look at European markets very quickly, so that's what happened in Asia. In Europe, you can see all of the indices have moved higher. That's on the back of this. Okay, so we got some news out of Germany. The economic survey actually beat expectations quite significantly there for June, even if the sentiment didn't. But these are the big numbers. So we got a better than expected employment number and a better than expected GDP number, both on the Q on the Q of comparing quarter-over-quarter and comparing year-over-year. So those are very positive numbers, and consequently, of course, we've seen the euro. Euro was actually looking quite tasty on the Aussie dollar. You can see there it's setting up very nicely. Just watch that 157.36 as a key level there. We'll look at euro yen. Again, similar sort of story. These are key lines on the daily charts as well. If we just have a look at this line is the key line on the daily chart. I think the top one there, you can see that is the top of that range there. So we're after dropping down last week, we moved back up and we're retesting this level. So there's approximately, and this is where the money is in FX at the minute, because there isn't any in daily charts really. So there's approximately 65 pips, or maybe even 50 pips up to the next sort of resistance. So a couple of things happening as a result of that European data that came across the wires just a short time ago. US dollar index is trading around 90 and precious metals are towards the top of the range again. But with that could be under pressure, because what's happening, if we look at the Nasdaq, again, we're shaping up for something rather tasty here. We can sort of see that we've already tested that level there. We've got a potential breakout trade here 2 days ago. There's yesterday's action. There's today's. That's the next key level. So if we break that 13,865 level, we could be seeing it push pretty quickly up towards that 14,000 level on the Nasdaq. So some interesting stuff going on. Here's the US dollar daily. Surprisingly good in trading today, but interesting just to see it's actually holding up okay against the euro, despite that good data. So there must be something helping US dollar along a little bit. So you can see that trading slightly to the upside. I guess it's because the Nasdaq is the only one of the US futures that's in positive territory at the moment, or in significant positive territory at the moment. So again, it's looking very interesting, and I'm hoping the message about me being cautious about taking short trades, you sort of getting through. Cryptos are testing support. For those of you into cryptos, let's just have a quick look at a Bitcoin chart, which looks pretty dreadful, to be honest. Well, I'll look at Ethereum first, which isn't quite as bad, but you can see it is moving down to support 2,265, the key level. If you look at Bitcoin, the pressure on cryptos is quite staggering at the moment. So yesterday's close represented the lowest close since February, and we've continued down there, and we're heading back towards 30,000, which was the intraday low on, and that was just radical candle on the back of some comments from Elon Musk. But we can see now we're down 50% from our highs that we hit mid-April, so around about 6 weeks ago. So crypto's under major pressure. And now we've had Japanese GDP out that beat, European GDP beat. And the good thing about these is they're not overbeating. We had a big move on Thursday in all asset classes, including, of course, Share CFDs, because of those hot jobs numbers that came out on Thursday. Then, of course, we had the non-farm payrolls on Friday, which wasn't quite as clever. And so we got that returning. Now we've got US trade balance. That isn't a major market mover. But there is one thing that is absolutely crystal clear about the markets at the moment, is they are phenomenally inflation sensitive. So any strong data may be viewed that good. It may be the situation as it was on Thursday. The good news is actually viewed as bad news for sentiment towards share CFDs. Also on Thursday, we've got the latest US CPI number out, and so that maybe will hang over market sentiment over the next couple of days. So maybe that if we do get a breakthrough, it'll be or retest of record highs, it'll be a cautious test rather than a bounce through that. So that's where we are now. Just have a quick look at, we've already had a look at where the Nasdaq is. Let's just have a look at where the ASX is. As I said, managed to eke out small gains today. You can see it's very much still in uptrend, now broken 7,300. So that not only is in light of today's trading action, but also the follow through that we've had with some of the US indices looking slightly better than they were earlier in the day. We didn't have a look at the S&P 500, I don't think, did we? On a daily, you can see a bit of a pullback going on there. It's interesting. But that's where it sits on the daily chart. There's a record high at 4233. So that's where we're at now. So I thought it was worth doing that, really just to sort of clarify where we're at now and the context in which we're looking to trade. Good on you, Alison. Drop me a line on that, Alison. I'll sort that out for you. Stocks in general, if one go, oh, wait a minute. Relationship between bonds and stocks in general, if one goes up, does the other go down? Yes, in simple terms. So generally speaking, we're talking about bond yields. So if you look at the relationship between the stock market and the bond market, essentially institutional investors, so managed funds, etc., have a choice as to where to put the money now. Historically, there's always been a fairly good chunk of that in the safest investment at all, which is US Treasury bonds, because you're guaranteed a return. Now, what happened post-pandemic was that dropped along with the interest rate drops by central banks. That pushed it down, and also, of course, the fear of depression. So the 10-year note dropped down to about 0.35%, I think, which is just outrageously low. So one of the things that's pushed the stock markets up is the fact that dividend yields were significantly better than that, and have continued to be so. Now, about 2 months ago, bond yields started to rise. And so what that means is that at 1.7%, which I think they're at now, they're slightly less unattractive than they were 12 months ago. And additionally, of course, because share markets continue to go higher, with that as one of the drivers, that dividend yields are far better than bond yields. So where would institutions most or prefer to have their money is that if you had a stock that was $10 and gave 5% yield, and it's based on a cents per share, so give a $10 stock gives 50 cents, that's 5%. Now let's say that stock is trading at 20 and they're given 50 cents, it means that that yield is 2.5%. So you've got a closing of the gap between treasuries and dividend yields, and that means that there's usually the negative relationship between bond yields and share market yields. Well, that makes sense. Okay, good. Right, so let's look at some stuff. Now, as I said, what I've done is I picked some of the major questions that I'm asked many times, and I thought I would just clarify for you guys. Or actually, what I might do to start with is just find out where you are. So you're probably in one of three places. You're trading share CFDs, you're testing share CFDs, or you're thinking about trading share CFDs. So if you wouldn't mind just ticking the box, that just gives me an idea about where you guys are. Now, as I've said on just about every session, please feel free to ask questions at any time. I'll do my best to answer everything that we do today. That's fantastic. Thank you. 3/4 of you voted is awesome. Great participation, guys. Really appreciate it. Okay, so about 30% of you trading at this stage, or in the process of testing things out. Cool. So here are some of the common questions. So the first question I'm asked time and time again is, do the common strategies discussed for other asset classes work for share CFDs? Now, absolutely. If you look at the let's see if I've got that slide somewhere handy. So this is the stuff from Trader IQ. Let me just find it. Maybe I haven't. No, maybe I haven't. Okay, so the 4 major strategies. Apologies for that. Let's see if it's here. Nope, don't think it's here on the home page either. Okay, no worries. So we've got 4 major strategies going on. We've got a breakout trade, we've got a trend reversal, we've got a bounce, we've got a fundamental approach, so based on a fundamental idea. Then we've got sort of accumulation and trend continuation, which we've talked about in a circle over the last couple of months or so. We've covered those in detail. So yes, they all work in the same way that they work for FX. At the moment, just FX short term, and they work for indices, they work for share CFDs as well. So that's one of the good things. You may have to do some tweaking. For example, when I used to do an awful lot of options trading, I used to use the 5 and 15 for these days for FX indices and share CFDs. I tend to use the 10/20 EMAs. as the 2 EMAs I have on the chart as standard. So it may be that you do a bit of tweaking, but the first start point is obviously have a plan, and the second is obviously trade it, and then you can start to mess with the parameters. What I would suggest is, as you're getting used to a new asset class, for those of you who are just starting out, choose the strategy you're most comfortable with, and for many people that's a breakout strategy. Another question I often get asked is, when would you use intraday charts with Share CFDs? Right, okay. There's a few occasions. So Twitter, hourly trade levels. Okay, I'm actually in Twitter at the moment. Was this one that I traded recently? Not trade levels, I wanted trade history. There we go. So intraday trade from last night. Entered it here. I actually entered it, I think, on the 15-minute chart. There we go. Entered it on a 50-minute chart on this bounce. Entered it here. Closed it here on a profit take because it was getting close to next resistance. So there you go. There's a bounce strategy. Okay, we had this engulfing candle. Broke that one on the back of 3 long wicks. Got in on this, and subsequently profit took on that one there. I'm trying to get in this again, actually. So first way you would use an intraday chart is if you're trading intraday. Now this is very, very intense, okay? Because you've only got a 6-hour window, slightly more, 6.5 in the US. But you really need to be on your mettle, and you can't be away from the screen if you're going to trade intraday Share CFDs. That's point 1. Point 2 is what often happens. So the second time I would look at an intraday chart would be I'll give you another one that I entered today that I didn't see till late in the day. Was EML. Okay, so entered EML on a breakout strategy. Okay, so that was entered today. Now, what you can do is, and obviously this was trading right up on, going higher, right up into the wire. There's a 5-minute chart, and closed at its high, which was sort of nice of it. Now, if I didn't get into this today, then what I will be looking at, let's assume it finished here yesterday. So what I will be looking for in that, I wouldn't trade in the first 15 to 20 minutes. So what I would be looking for, let's put it on a 15-minute chart. So what I'll be looking for is, there was the high from yesterday. So that was a potential entry yesterday, okay? Because it broke that level of 350, which was the key level. So that may have been an entry yesterday, but it may have not been quite far enough over that to justify an entry. Or it may just have been, it happened in the last few minutes and we missed it. Okay, so what I might do is I'll say, right, okay, after the first 30 minutes, then it was an entry yesterday. If there's evidence of a continuation, I might get into that. So that would be the, so even though I'm trading the daily chart, okay, what I'm doing is it's already a potential entry, but I want confirmation of that. So I'm going to use this candle here for confirmation. It's a continuation of the trend that started yesterday. Okay, so that's the second reason. It's already an entry, and I'm using that first hour's candle action to say, yes, it's still good, because I didn't get into it at the end of the candle yesterday. Now, what I wouldn't do is this. Difficult to come up with an example of this because TWE. Okay. So TWE breakout strategy looks pretty good. So let me just say, there was the breakout. Okay, so now we broke out here. So if we looked at the weekly chart there, we'll pop it on the daily chart. So there was the breakout. So we see this, and it's moving up quite nicely. Okay, but then we then we get a little twitchy. We're in profit now by, oh, what are we in profit by now? 3%. Okay, so what we then do is we think, all right, let's look at the 30-minute chart, and we see this candle after all, and we think, oh my God, it's going down, and we click the exit button. Okay, our reality is we're trading entry and exit on the daily chart, and our exit strategy, in this case, we probably use the 10 EMA, is based on our daily chart, not on a 15-minute chart or a 30-minute chart or even an hourly chart. Okay, because we'd have seen that open and started to get panic and take it off, when the reality is this could be a perfectly good trade, closed only slightly up, but it could be a perfectly good trade as tomorrow. There's no reason to exit this, particularly as it's broken that line there. Okay, so that's when you don't use intraday charts. So just to reinforce, you can use intraday charts if you're trading intraday. Second reason is it's already fit your entry criteria and you're wanting confirmation the following day, simply because you missed the entry. You saw it after market close. And what you don't do is decide to trade on a daily time frame and then go down to a 5 or 15-minute chart or even a half-hour or hourly chart. Does that make sense, guys? Cool. And it's really sort of quite it's really sort of quite important, because this comes from a place of we talked last week in a circle about trading confidence. Ilan from Auto Chartist is coming this week, so that was a little bit of a last minute thing. But really that's a sign of if you start to do that, then what I want you to do is think, well, what's making me do that? Why am I not confident enough in my plan to trade it? And it may be just you need time to develop that. And if you do it, find some evidence to say, hey, look, this is what would have happened if I'd actually followed the plan, and then you can do it. Then you can compare what would have happened if you had followed your plan, and invariably it's usually a good thing. So should I open positions on Fridays? A really difficult one, because I understand the reluctance to open positions on Fridays, because we could have a little bit of reposition at the end of the week from shorter term traders, which often happens. We also could have some big data like we had this Friday just gone, like the non-farm payrolls. There's not many other data points come out on Friday that are so significant. In fact, there's not many data points that are so significant, full stop. But so what I would say is much of it may depend on where you are in the market. So if you've got quite a few positions open already, and you've got the weekend risk and the potential for gap in going on, I wouldn't worry about swap. Swap is not going to be the thing that hurts you. What's going to hurt you is a big price movement. So what can create a big price movement at the end of the week? Well, first thing is if there's been a big move either way. So if it's been a really strong week, you're likely to get some profit taken on Friday, and vice versa. If it's been a really weak week, poor week, maybe a better way of saying that, rather than using too many weeks, you'll often get people closing down short positions on a Friday if it's been a week which is downside significantly. So I wouldn't trade on Fridays in either of those cases. In fact, you may even choose to take risk off the table. Outside of that, it's actually really difficult to call, because if we look at the Nasdaq, there was I think it was 3 months ago where there was like 11 Mondays on the spin where the Nasdaq actually had a good day on the Monday. So if you'd entered positions on the Friday in most of the tech stocks, you would have done very well by Monday evening. So what I would suggest you do with that is, first of all, obviously you take into account where you are, how many positions you've got open, what risk are you actually putting yourself under by staying in. Okay, so I had 9 positions open on Friday. I knocked that down to 3. Okay, by the end of Friday. Some of them were because they were hitting exits. hitting trail stops. The others were because simply there was a big data point coming out on Friday night. So you may choose to reduce the risk on Friday and certainly not open it anymore. So that's an example. If there's none of that there, if your position fairly small, you don't mind. And the thing is, it's one of the advantages of the US that obviously once the US market opens, a lot of the data's out. So on Friday, the non-farm payrolls was out and the market started going gangbusters to the upside. So if you'd have had a pending order in on, let's just have a quick look. If you'd have had a pending order in on FCX didn't do pretty well, so let's have a look at something else. I'm trying to keep it real by trading something by let's look at Twitter, because Twitter is one that we had talked about on Thursday as a potential chart of the day in the US. So if we look at an hourly chart, so these are days. So if you'd have had a pending order there that said get in at this point, okay? So we saw this on Thursday. We said, hey, looking smart. So that's just want to get this right. Tuesday, Monday, Friday. Okay, that was Thursday. So if we'd have seen that on Thursday, oh, that one there. Okay, we'd have seen that line there and we thought, oh, we quite like this. Actually, no, let's not. Okay, but we want to see it break this level at 57.36. Okay, then we would have been in there on the after that data had happened. If that data had come in, really strong, we would have seen it. Wouldn't have seen this happen. Of course, it spiked up at the end of the day again. So we're away. Okay. So if you are trading the US markets, it can be an advantage that US data comes out and then you get a market response to it. Then you just got to decide whether there's going to be follow through or not, and that's really the tricky bit. So in this case, we would have got in at this point, put a stop down here, and we would have been fine with this. We obviously would have been at this stage somewhere in the region of nearly 3% up. Okay, so I hope that made sense. Should I get out of a stock if it's about to go ex-dividend? I wouldn't. Essentially, it's already priced in. So if you're long a position, then and there's a dividend there of 30 cents, you expect it to drop by 30 cents on open, and then it's whatever the market's doing after that. So I would say that that's not really, because you get a dividend credit to account for that, or a dividend debit to account for the drop that's happened, then essentially you're not losing anything by the dividend. There are ways of playing dividend trades, another story for another day, and not one that I must admit I've had any success with at all of any note. Sometimes it's worked, sometimes it hasn't. But the only time I would be cautious is with a stock that is traded for dividend. So Telstra's always been a popular stock in Australia, not just because it's a fairly stable company, but also because it gives a nice dividend. Property trusts usually give nice dividends. So there are people that just get into them for their dividends, and so will exit once the dividend has been done on some occasions. So if it's a stock that has a particularly high dividend yield, you may be a little cautious, because it may be that people are playing that game. But generally speaking, it wouldn't be something that would stop me getting in. It would just be an awareness that it's happening, and obviously want to check that we get a credit on the account accordingly. Should I have a stop on the system? This has come up a couple of times, because usually I don't with Share CFDs, and that doesn't mean I don't have a stop. So A, yes, you have a stop, but B, there is some occasions where particularly opening, and sometimes closing is really quite volatile, while the market just finds its groove, where spreads are quite wide. and I don't want to be taken out because of that. The other thing, of course, is something can gap below your stop, and then you've got a decision to make. Do I see? So it's already an exit level. Does that mean I get out right now, or does it mean I see if there's any recovery during the day? Now I'll cover that. I'll give that some airplay next time we meet at the back end of the month, just to show you how that works. But it's very individual mag thing, so I don't want you going to try and play that game yet until you get clarity on that and test it out and all that sort of stuff. So it's your choice whether you have a stop on the system or not. I tend not to, because I don't want to be whipped out by first 5 minutes trading. But that does not mean you don't have a stop. You should have a stop and adhere to it. The other questions that tend to pop up quite often is about relationships between US and ASX. So are there sectors which, if they do well in the US, we can expect follow through in Australia the following day, for example, or vice versa, of course? If the ASX has a good day in a particular sector, are we likely to see that happen in the US as well? So what I would say is that not often, okay? There's obvious stocks which would be the case, particularly in the material space. So many of you, when I've been talking about copper, we've got Oz Minerals or OZL in Australia, and we've got FCX or Freeport McMoran in the US. They both are primarily copper stocks, but the relationship isn't between those stocks. The relationship is with the price of copper. So likewise with some of the energy stocks, it tends to be the underlying commodity rather than one sector influencing the same sector elsewhere. The banks are interesting because obviously we've got, if you compare bank versus bank, you've got the JP Morgans of this world, which are very similar in terms of that they have a heavy investment arm to Macquarie, for example. And then you've got your more standard banks like possibly Wells Fargo comparing to what our big four. So I haven't got a definitive answer for that, but generally speaking, let's have a look at a chart and see what you think yourself. So if we brought on, let's bring on JP Morgan. Okay, and so you can see it's doing okay, and we just need to update the data on this. So it's sort of paused, it's trading towards the top of the range. In fact, it's looking quite nice if it breaks this 166 level. And then we look at Macquarie, which is in a similar sort of vibe. And really those charts are quite very different. And that's not just because of earnings. So I would say the sector, it actually doesn't look like a bad chart, that. It's almost a very choppy double bottom type of formation. So it could be one to watch tomorrow if it breaks 153.87, 153.90. Okay, so that could see us up maybe sort of, yeah, 3.5% possibly. So keep an eye on that. So those relationships are a bit tenuous. They're not really very obvious. Unless it's earnings. So you tend to find that if JP Morgan reports good earnings, then you often see Macquarie doing likewise, or doing likewise in terms of price after that, because there is an assumption there, like there is in any sector, that if one company within that sector does well, then so will the rest. Let's just quickly check in on Euro Yen. Doesn't want to break through there. Euro Aussie doesn't want to break through there. So there we go. That's FX fee at the minute. Okay. Okay. So now, what I wanted to do was just look at some additional exit considerations relating specifically to share CFDs. Bottom line is all general exit approaches are relevant. So of course you're going to have a stop, you're going to have a trail stop, and you're going to choose your approach for that, of course. and any of them work. You just need to follow through on it. So whether we use a it'd be interesting to see what a MACD on PLS was. No. So whether we use, so at this stage, if we look at PLS, because I'm now out of this, because PLS was one of ours from last week, and it's really on the basis of a profit target. So we had a profit target there of around about 133, and it hit that. Okay, so that's not any other exit. It's not our MACD signal line. It's not our 10 EMA, which we would have probably used because of the distance between that and rather than this and the 20. So so the exit rules still apply. If we're trading Worley Parsons, the reason I'm out of Worley Parsons is exactly the same reason. There's a profit target there. So again, this is one of our trades of last week from the live updates. There's a profit target there. Let's nick a nice little 5% from that, just to show you I'm not blowing smoke up your backside. So there you go. Okay. So profit targets are the same. Now, if we'd gone, let's look at QBE. So if we enter QBE based on that breakout, we might set our stop on the 20 EMA and would still be in this. Okay. Now we might measure the distance between here and here and think, whoa, that's a bit far. It's 4%. We're not happy with that. So let's say our original risk was there. So we entered here. There's our original risk. What percentage is that? That percentage is 4%. So it's still within that 4% from where we are now. Okay. If it gets much harder than that, that's of course when we switch to the 10 EMA. What would have happened if we'd used it on this breakout here? Well, there we go. We'd still be in it. Okay. What's that? It's about a month ago. I think we actually pointed this out as a potential breakout. One I missed. Okay. Yeah, Dave, could you ping me an email, mate? And I'll send you the link through. Not a worry at all. Okay, so general exits, all the same. Now, obviously, one of the additional challenges of share CFDs versus some of the other asset classes is earnings. And it's easy. So what you've got to do with earnings is you've got to put two parameters in your trading plan. Firstly, you put in, as part of your entry criteria, how long before earnings report you're happy to get into this trade. So is it 2 weeks? Is it 4 weeks? How long is it before the next earnings report? So if you sort of were to enter JP Morgan, it's due to report in July, from memory. So what does that mean in terms of when you'll enter it? Are you quite happy to enter it and at any time, and then close it? Are you quite happy to enter as long as there's at least 2 weeks for it to do its thing? Or if there's less than 2 weeks, you're going to say no, it's not for me, and on you go. So there's a decision to make at how long before earnings in terms of entry, but there's also the same decision in terms of exit. What we tend to see prior to earnings release is the market positioning themselves for what they think will happen with earnings. Now then, of course, you've got, it is going to gap. Okay. Now, just a word of warning is, if you've entered a trade a little while ago, you've been in 3 or 4 weeks, and yeah, you've not checked in the earnings date, fit your entry criteria, was a little way away, just keep on reminding yourself when that earnings date is. There's a couple of times that you can be caught with that, that I've been caught with that over the last sort of 12 months, that I've been in positions and whoops, the earnings has reported and one went with me and one didn't. But it is essentially flip of a coin stuff. So you really don't want to be playing that game if at all possible, unless, of course, you're in a trade on a long-term fundamental idea. Okay, so be sure in your trading plan you put your entry and exit decision making in relation to when earnings is due. The other exit consideration would be, and I sort of inferred this before, and it's really hard to articulate, but I said before that there's a fairly major chance on Thursday that there is going to be a market move. Sorry, after Thursday, so Friday potentially big move. Thursday night in the US, big move, okay, because of this inflation data. Now, you'll get some market repositioning before that, a little bit of market caution probably creeping in, but then you'll get a big market move after. So what do we do on Thursday if we've got some ASX positions open, knowing that this big data point with this market moving potential, which we could do absolutely nothing about until market opens the next day? What do we do with that? So I've talked before about maybe certainly at a high intermediate or even advanced level, one of the things that we should be doing is looking at maybe giving a risk score to where the markets are now, not only in terms of what they're doing, but what's coming up imminently. Okay, and we talked with reference to position sizing for entry, but equally so if you've got positions, so the galaxy, or if you've got positions, a lot of positions open, then maybe taking some risk off the table is not a bad thing. Now, on the basis of that, so again, articulating this within your plan is really quite difficult, but perhaps if you're exposed to multiple positions, so if it could be a whole market event, like Thursday could be, you might say, prior to a whole market event, I'm going to make sure that I've no more than 2 share CFD positions open. Okay. Now, of course, then your challenge is to define what a major market event is. So that would be one way to articulate it. Or you may say, I'm going to make sure that I have, if there's a sector moving event. So we've got an OPEC meeting. We're in Woodside, we're in All Search. Let's make sure we're not in both before that OPEC meeting announcement goes on. So again, you could sort of say in your plan, if there's a significant sector moving event, then I'm going to make sure I have no more than one position open in that particular sector. Does that sort of make sense? So if that's the case, if at some stage you are going to reduce the number of positions you have open in the market for whatever reason, might be that you can't keep a close eye on it, might be that you've just been accumulating positions quite happily because the market's going up and now the whole market's just looking as though it's maybe run out of steam a bit, and you know for certainty that the riskiest time is when a market turns. Okay, when it turns on a dime, as it often does, we've got a fast trend reversal, we're in 6 positions, oh my god, 2% risk a trade, we're now down 12% on our account. Okay, so first of all, you can mitigate that risk by specifying the maximum number of positions you have open, but secondly is through doing this sort of approach, is by looking at what's happening in the market. And that's why we talk with that trader IQ thing, that's why we talk about market IQ being critical. So we look at how many positions we have open and we say, how does that fit with where the market is now? If the market's in an okay place, no major risks, no major economic data, we're good to go. We're good to stay in these positions. But by Thursday, we're going to have reduced our positions down. Now, if we are ever to do that, then obviously we've got choices to make about which positions we close. So again, if we're reducing positions in share CFDs for I guess it's relevant to other asset classes as well, but I want to focus on share CFDs, then we've got to have some system for deciding which positions to close. So generally, traders, depending on their mindset, would tend to do one of two things. So let's say you had 4 positions and you wanted to close 2. So some traders would close down the 2 profitable positions, whereas other traders would close down the 2 losing positions. But really, that goes back to why are we, that's not congruent with anything else you're doing. Okay, it doesn't bear any resemblance to anything else that you do or shouldn't be doing. It's simply based on what's happening in that profit loss column. Okay, so it doesn't matter whether it's $1,000 down or $1,000 up, or 500 down or 500 up, or whatever, or 50 down or 50 up. It doesn't matter. Okay, that should not be the reason that you use for closing positions down ever. So I'm going to give you a couple of examples here. So let's maybe use the okay, let's use the PLS, because I've talked about these quite extensively. So put PLS on here, and we're going to also put Galaxy on here. Right. So ignore today's candle, because Galaxy, in fact, neither of them did particularly well. Okay, so let's say we're in on a breakout trade, as we discussed there, on PLS and on Galaxy, maybe there, on this candle here. Okay, and we're at Friday, okay? So we're at Friday, which is this candle here. Okay, on PLS, it's this candle here. So if we, so we're in a situation where both are in profit, but we want to close one of them down because they're in the same sector. So how do we make that decision? We certainly don't make a decision on how much profit there is at this stage, because it depends on the position size, etc., etc. And we don't make a decision on the percentage it's gone up. So that one moved up 10%. This one moved up Friday, it moved up 7%. So it wouldn't automatically close down Galaxy or close down PLS simply because it's a high percentage. So what can we do? Well, one of the things we can do is say, well, look, looking at where we've got our stop now and our amount of risk that we've got to the downside, we can also look at what the risk is to the upside. So on Galaxy, we put our next resistance at that level. With PLS, we put our next resistance at that level on Friday. Okay, so on Friday, PLS were right underneath the next resistance. Okay, right underneath the next resistance. So let's say our profit target is on here. We've got essentially 0.38% to make to the upside, and we've got 6% to lose to the downside. On Galaxy, we had Friday, we had 2.5% still to the upside, and we had potentially 4.6 to the downside. So logically, and I know it's difficult because it goes against what actually happened, but logically, which is the one that's most likely to have run its course is the one that's closest to that key level, which is also the one that's got the most risk to the downside. Well, we said that was 3.5%. We said PLS was on Friday 5.5%. So between those two, both of which have dropped off since, the one we would have taken off, or the decision making around them, would have been the one that has the least potential upside and the most potential downside based on your technical chart. Now, the reality is, got out of both of them, okay, because they're both pretty damn close, and I needed to reduce positions accordingly. But that's the thinking that goes behind it. When you're faced with, I need to reduce, I've got two positions in this sector, I need to take one of them off the table. Which one? How am I even going to start to make the decision on that apart from profit? So that's a technical, remember, using technical reasons to get in, and you're using technical reasons to get out for everything else apart from which one do I use to get out. So you need to see if you can come up with a technical system that does that, and that's a good way to do that. So let's use another example. So let's say we were in Okay, let's use, copper's looking ugly again. Let's use ANZ. Okay, so let's say for some reason, let's put it on a daily chart. For some reason, we were in ANZ, let's say today. Oh, sorry, let's say let's say on Friday. Okay, so there's Friday's ANZ candle. Here is Friday's Macquarie candle. Let's say we go on these on a bounce for the hell of it. We had to make a decision, so what we could do is say, right, there's our line in the sand. In terms of where we are now, we're actually right bang smack up against that. Minus about 0.12% with ANZ. Let's put it on a line chart. And you see on Friday, we actually broke through it. So which one of these will we get out of? Will we get out of Macquarie? This looks the stronger, more strong technically. It's actually broken through that potential level it could have got stuck at. And risk is 1.9%. If we look at Macquarie, risk to the 20 let's say the 10 EMA is 1.2%. So there's not much difference in risk, but there is in which looks stronger technically. So that should be the decision that you use. Now, if you want to make this easier, try and get rid of the profit loss column on your toolbox at the bottom, and just make a decision on what you're seeing on the chart. Okay, so if you have the necessity to reduce because of market risk, make the decision on what you're seeing on the chart. Now, as I said, usually the best way to do that is to compare upside risk versus downside risk of where you are right now. Does that make sense? I sort of hope that's useful, because I know it's something that that a lot of people battle with, recognizing that that market turn is the biggest risk. And if there are things which could turn the market, it makes sense to reduce positions. Okay, that's all good. So that's really what I was going to cover today. As I said, I hope that's sort of useful. Now, just for those who want to, if you want somebody to connect, I know a lot of you are in already. I know a lot of you are just testing now. But if you are moving off the fence and you want to give this a go, obviously you need an MT5 platform. You need a funded account, and you need I'll give you access to a Share CFD course. So if there's any of you that want a little bit of connection to make it happen, that haven't already indicated such, then just click on that yes I want inbox, and I'll get one of the guys to connect with you and make it happen. I'm just going to leave that open for a second or two, just while. Oh, you're very welcome, Ian. It's something that really, the exit thinking is really about, if you get that right. And if I look at any trades I would put in the bad trades category, it's usually because there's been an exit issue there I haven't really considered. So you're learning vicariously from a lot of the experiences that not only I've had, but also many of the guys that I've coached over the years. So that's really kind, Peter. Thank you very much. Alison, don't forget to drop me. I'm just going to open all these questions because there's quite a few and I've messed up the order a little bit. Sorry, I need to close that poll down. Yeah, just doing a last check through. No worries, Alice. I'm glad it was useful. Great stuff. Okay, I think I've done. So yeah, look, join us tomorrow for your next Inner Circle session. If you're not part of that already, get part of it. It's Ilan coming along to do his thing. So just make sure you've got the link for that, just in case you haven't already. You're all part of the live updates, aren't you? The live market updates. If you're not, drop me a line. They happen on Tuesday and Thursday lunchtime. So if you want to be part of that and you're not already, then drop me a line. Right, I'm just going to put Inner Circle link in there. As I said, it's Elon tomorrow, so there you go. That's that done. Thanks, Ian, mate. Absolutely, Rachel. Great stuff. Okay, guys. Well, look, we'll just check in on what the futures are doing, shall we? Just as a good thing to do. And they haven't actually moved very much. You should see them on your screen right now. You can see the Nasdaq is still around about 0.2% higher. S&P and Russell pretty flat. In fact, absolutely flat. And the Dow's about sort of where it was. And gold's struggling to hold. I'm not convinced precious metals are going higher than this, to be honest. But anyway, that's my thoughts. Anyway, take care of yourselves. Trade safe. We look forward to seeing you tomorrow if you're around. If not, but you're at live updates on Thursday. It'd be great to see you then too. In the meantime, we'll catch you again very soon. And thanks for some of the feedback that you give me on Trader IQ. Some of you have already had a look at that. That's really kind of you. Thank you. Really appreciate it. All good. Best email is mike.smith@gomarkets.com. So mike.smith@gomarkets.com. See you later, Cameron. See Mike. Good to see you here, buddy. See you later, Ross. Take care of yourself, buddy. Catch you later, guys. Enjoy the rest of your evening. Bye-bye for now.